Hi, Assalamualaikum. My name is Mohamad Syafiq bin Mohamad Nizam. So today I will present about capital asset, how capital asset pricing model and working capital management being used in the company. So we move to the capital asset pricing model, CAPM. So the capital asset pricing model describes the relationship between systematic risk and expected return for assets, particularly stocks. So CAPM is widely used throughout finance for pricing risky securities and generating expected returns for assets, given the risk of those assets and cost of capital. Portfolio theory is a description of how rational investors should have build efficient portfolio. So capital market theory tells how assets should be priced in the capital market. Under CAPM assumption, investors not only can divide their investment between the less risky asset and some risky asset, but they can also invest all their money in the risky portfolio and borrow additional funds at the interest rate of risk-free and invest these borrowing funds in the risky portfolio. So next we move to the how to use CAPM, capital market line versus security market line. So CML shows the rate of return for a specific portfolio. The SML represents the market risk and return at a given time and shows the expected return of individual asset. And while the measure of risk in the CML is the standard deviation of risk returns total risk, the risk measure in the SML is systematic risk or beta. Securities that are fairly priced will plot on the CML and the SML. Securities that plot above CML or the SML are generating returns that are too high for the given risk and are underpriced. Securities that plot below CML or the SML are generating returns that are too low for the given risk and are overpriced. Okay, so we move to the CML, capital market line, which represent portfolio that optimally combine risk and return. The slope of the capital market line is the Sharpe ratio of the market portfolio. The efficient frontier represent combination of risky assets. So moving up the CML will increase the risk of the portfolio and moving down will decrease the risk. So subsequently, the return expectation will also increase or decrease respectively, where the formula will be given, and then the RP is stand for the portfolio return, RF is risk-free rate, RT is market return, standard deviation of market returns, standard deviation of portfolio returns. So we move to the capital market line, which represent portfolio that optimally combine risk and return. CML is a special case of the capital allocation line, which CAL, where the risk portfolio is the market portfolio. Thus, the slope of the CML is the Sharpe ratio of the market portfolio. The CML provides a risk-return relationship and a measure of risk for efficient portfolio. There is a linear relationship between the risk as measured by the standard deviation and the expected return for this efficient portfolio. So next, we move to the SML. When the CAPM is depicted graphically, it is called the SML. The SML can help to determine whether an investment product will offer a favorable expected return compared to its level of risk, which the following given is the formula. And then ERI is expected return of investment, RF stand for the risk-free rate, BI is for the beta of the investment, ERM minus RF is the market risk premium. Normally, it is a straight line which reflects the required return in the marketplace for each level of non-diversifiable risk, which is stand for beta. The expected of required rate of return of a risk asset is determined by the risk-free rate, RFR, plus a risk premium for the individual asset. The risk premium is determined by the systematic risk for the assets, beta, and then the prevailing market risk premium, RM minus the RFR. Okay, so next we move to the working capital management. The working capital management involves day-to-day decisions, which regarding investment in current assets and how the assets are to be financed. The primary purpose of this chapter first is to review alternative strategies for investing in working capital, and second is to discuss alternative strategies for financing working capital. So decision in these two areas will affect both firm business and its expected rate to return and hence its market values. So next, we move to the policies of working capital management, which first is relaxed policy. This is a low-risk policy whereby the firm will maintain large amount of current asset coupled with liberal credit policy. It has high liquidity and potentially low return from investment due to low productivity of current asset relative to fixed asset. So next, we move to the restricted policy. On the other hand, restricted policy is a high-risk policy whereby it reduces current assets. So holding to a minimum coupled with stringent credit policy. Lower investment in current assets enable the firm to increase investment in other productive investment and thus will result in higher returns. So next is moderate policy. So this is middle the road policy in between relaxed and restricted policy. It will result in moderate risk and returns. High current asset investments such under relaxed policy will reduce risk of technical insolvency, but at the same time it will result in lower returns due to lower productivity of current assets. Therefore, investment in current assets should be at a minimum level without sacrificing the liquidity requirement. As such, more funds are available for investment in fixed assets, there are more productivity. The use of current liabilities or short-term financing to finance current assets are generally less experienced than long-term financing, such as long-term debt, preferred stock, and common equity. Short-term financing represents a relatively lower cost of capital and could improve the firm profitability. Consequently, aggressive use of short-term financing leads to a decrease in net working capital and hence increase the risk of technical insolvency. So next, we move to the approaches to working capital management. There are three types, which first is heading approach. Heading approach measures the maturity of assets and liability, that is the firm use temporary financing to finance temporary current asset and permanent financing to finance permanent assets. In this plan, the firm will finance fixed and permanent current assets with long-term debt, while the fluctuating current assets will be financed with short-term debt. Since the approach matches the financing maturity and the assets requirement, there is no need for emergency funds and either funds are non-existent. This approach results in moderate risk with moderate returns. A firm wishing to adopt a financially aggressive or conservative approach may modify the above approach by focusing on using more of temporary financing or permanent financing respectively. So next, we move to the aggressive approach. In this strategy, there involves more risk as it partially matches the maturity of assets and liability. It uses short-term or temporary financing to support a relatively large portion of current assets. In this plan, a firm would finance all fixed assets with long-term financing, but only a portion of the permanent current asset will be financed long-term. The remaining permanent and the fluctuating current asset will be financed with short-term borrowing. In this approach is more risky for the firm because the current ratio is less than 1 and there are potential problems in renewing the short-term borrowing arrangements. However, as we will see in a later section, short-term debt is often cheaper than long-term debt, so many firms may be willing to sacrifice safety for possible higher profits. And for the last part is conservative approach. This approach has the lowest risk among the working capital approaches, whereby the firm uses long-term financing for the majority of its asset, resorting to the use of short-term financing only for the very peak requirement. In this plan, the firm supports fixed permanent current assets and average temporary current assets with long-term financing. Then, during slow periods when the need for temporary current asset is low, the firm will have excess liquidity and buys short-term securities alternatively. When the needs for current asset is at peak, the firm sells off its short-term liquidity investment and borrows short-term if necessary. Most of the time, the firm will have excess liquidity and this reduce the need for temporary financing. Hence, it results in lower risk of technically insolvency. Conversely, the returns are low. This is due to higher cost of permanent financing and low returns from marketable securities investment. Both of these factors combined will result in a relatively low average return. And that's all from me. Thank you.